In this video, we're going to talk about bond valuation, and some of this will be review and some will be some relatively new stuff um, to the finance student, if you will. So let's work our way through the chapter. So what we're working on here is to try to identify in the end what is the cost of debt, and it's all a component of what we refer to as the weighted average cost of capital. And of course, this implies we need to know something about the firm's business risk. We need to know about market interest rates, market risk aversion, the company's debt equity mix. These will all have impact on the weighted average cost of capital. So we're going to start with the valuation of bonds. Now, if you think about it, the value of a bond is what an investor wants to pay to buy the bond. So if they're buying the bond, that implies that the company, the borrower, has to pay the bond, has to pay for that. So the idea here is maybe we need to recognize that what the company pays is exactly what the investor gets. So what I mean by this, the cost of debt is equal to the yield or the return to debt. So we're going to start by establishing how we calculate the returns on debt. And of course, that flows through to then what is the cost of debt. There are many common features. I'm sure you're well aware of most of these features. As far as the par value, we know that relatively speaking, it's always $1,000. Default risk is the chance, obviously, that they won't be able to make interest payments. And we'll discuss how that is identified and how the marketplace takes care of default risk. There is something called a call provision, and this call provision basically says that a company can refund its debt. So what we refer to it in the more common personal finance world is this is refinancing. And I think we know how everybody knows how refinancing works. If you want to pay off some debt to reduce the cost, you borrow money and pay off that debt with other debt. So that is essentially what the call provision is. Most companies have what's referred to as a deferred call. When the debt is created, there is a time frame where the company is not permitted to call the debt. They have to wait. Usually this obviously just gives the investor a little bit of time to get settled and have the investment for at least a little bit. So again, this call provision, again, we'll talk about this a little bit later on in the valuation component when we get to some more quantitative things. Certainly, the company decides how to do this. If the company decides they want to call, this is a disadvantage for the borrower. Since it's a disadvantage for the borrower is going to want a higher rate of return to buy these kinds of bonds. So this debt will have a higher cost to the corporation. It will have a higher return to the investor because of this. Obviously, investors don't really like the fact that you could call and take away their investment without them having any choices. There's something we've talked about in some other videos along the way called a sinking fund. This essentially sets up the stage so companies can pay off their debt. I mean, if you think about it, if you're going to borrow $100 million, and the way bonds work, as you know, it's interest only until it matures. So you have a 30-year debt for $100 million. you're only going to pay interest on that debt until the very last day, and then you're going to owe $100 million. Well, who's going to have $100 million saved up in an account so they can pay off that debt? And the answer is nobody. So this is a mechanism that reduces some risk for the investor. It shortens the time frame that we're actually going to owe money. But this is actually a great way for companies to manage their debt over time. So how this essentially works is they can call X% at par per year for sinking fund purposes. So what they do is they're just going to call this debt at whatever the cost of debt is, R sub D, if it's below the coupon rate and the bond is selling at a premium. So they want to call this when obviously the bond is selling for more than $1,000. Now, if it's the other way around, if the required return of the cost of debt is above the coupon rate, the bond is going to sell for at a discount. In this case, they're going to go out and they're going to purchase from the open market the debt. So they have choices of how they're going to get the debt and how they're also going to retire this debt. So again, we will talk a little bit later on about how the sinking fund is set up, and then we'll talk about some of the strategies again later on. So how do we find the value of a bond? So we have a AAA rated 10-year, 10% coupon bond, and the yield to maturity or the required return on the debt is 10%. This is our bond valuation and duration workbook. It's the worksheet. And as you can see, obviously the yellow boxes get data. So in this case, we have the bond value, 10%. If the required return is 10%, the bond value is going to be $1,000. But as we know, things change in the world. What happens if interest rates change? What happens if interest rates decrease by 0.5%? What if this goes down to 9.5%? If interest rates go down, bond prices go up. What happens if the company becomes riskier? Let's say that the company degrades from a AAA to a AA bond, and this causes a 2% increase in it. What's going to happen to the value of the bond? Again, if risk goes up, the value goes down. One of the things to remember is that typically bonds pay interest semi-annually. So you could change this coupon to a 2, the compounding frequency, and that would recalculate everything based on semi-annual compounding rather than just annual compounding. So again, let's assume the bond was issued 20 years ago and it now has 10 years to maturity. What's going to happen to its value over time if the required return remained at 10% or 13% or 7%? So what happens to the value of debt over time? And again, looking at required returns, what ultimately happens and how would this affect the company? So we see if the required return is 10%, if the coupon is less, right, or excuse me, if the required return goes down, we know the value goes up. If the required return goes up, right, if it becomes more risky, we know that the value goes down. Now, one of the things, and one of the more important parts of this graph is that in the end, when it matures, regardless of what happens during its lifespan, the value of the bond when it matures is $1,000. So when we think about bonds, there's a couple of terms here, right? A premium bond has a value greater than 1,000. A discount bond has less than 1,000. Again, it's the bond obviously changes over time, and it's going to go above and beyond, or above and below that $1,000 mark, depending on what happens to interest rates. And again, we understand how interest rates affect the value of debt. So what is yield to maturity? Again, it's the rate of return you get if you buy the bond and hold it to maturity. It assumes the bond won't default. Later on, we'll look at some information about the probability of default. And typically, if we're looking at AAA, AA, and A bonds, the chance of default, even during recession times, is typically less than 2%. So we'll look at that a little bit later. But obviously there are bonds that you can buy that will increase that debt level. So, or that the actual interest rate or the required return on the debt. So on a 10-year, 9% annual coupon bond against $1,000 par value, if it's selling for $887, what does this do? Well, this is going to help us to calculate. Again, notice we've left required return blank because we want to find out the return if you buy this. So this bond has a 10.91% yield to maturity. So what does that mean? If you buy this bond today for $887, you will earn 10.912% between now and the end of the term. So let's break that down a little bit more. If the coupon rate is greater than the required return, the bond's going to sell at a discount. If the coupon rate equals the required return, it's going to be at par. And again, if it's greater than, it sells at a premium. And again, this required return rises. If it goes up, price falls. And of course, at the end, as we've just mentioned, the price at the very end, it has to be equal to the par value of the stock. So let's look at some returns here. So we have calculated the yield to maturity in this previous bond, but that yield to maturity has some components. Every year that you own the bond, you can earn some return on the interest, and you can also eventually earn some return on the capital gains of the bond. So let's think about how that might work. The current yield for this bond that we talk about is the interest, the coupon, divided by 887. So the current yield is 10.15%. So if you subtract 10.15 from the entire yield to maturity, you will get the capital gains yield, which is 0.76, right? So they also give us another way to do this. I haven't found this to be all that convenient to look at, but in general, that is how this breaks down. Most of the return that you receive comes from the cash. It doesn't come from the capital gains of the bonds themselves, usually. So again, here we are. 10.15 is the current yield. 10.912 is the yield to maturity. And the difference between those two provides us with the 0.76. Again, that's just the difference between the yield to maturity, the total return you get if you buy it and hold it to maturity, and the current yield that you earn on an annual basis. Now, of course, the current yield changes from year to year, just like the yield to maturity might change. But if it's always just the difference between the two. So that's all for this video. We'll continue with some more bond discussion here in a couple of minutes.